Ladies and gentlemen, it is 12 p.m. Pacific Standard Time in California. Welcome to the Dylan Hoy Experience end of the week market recap, to be exact. Thank you to all of the members of the millions for tuning in. And I'm not going to lie to you, it has been a pretty interesting week in terms of finance. We have the traditional side of finance being one thing, and we're going to cover that first. And then to end off the end of the week market recap, for today, we are going to talk about what has been going on in the crypto world, because this is, I consider it a watershed moment in crypto, but I don't want to spoil it any further. So let's just talk about some traditional finance stuff for right now. Probably the biggest piece of news to come out from the traditional finance wing is the CPI numbers coming out this week on Thursday. So here is the CPI, or inflation breakdown, for October 2022 in one chart. The consumer price index jumped 7.7% in October versus a year ago, and it rose 0.4% during the month. However, it has been cooler, and the inflation now is considered cooler by estimates. Inflation was cooler than expected in October, although household staples such as shelter, food, and energy remained among the largest contributors to consumer prices, still rising at a historically fast pace, the U.S. Bureau of Labor Statistics said Thursday. The Consumer Price Index, a key inflation barometer, jumped by 7.7% in October relative to a year earlier, the smallest 12-month increase since January. Economists expected a 7.9% annual increase, according to Dow Jones. Basically, a basket of goods and services that costed $100 a year ago costs $107.70 today. Now, here, I just want to take a look at and run it back just a little bit to the actual CPI numbers versus the estimates. Again, having inflation underperform from an estimated to actual standpoint is it's a good thing. I'm happy that it's slower than expected. But I don't know if we're out of I don't know if we're out of the thick of it yet. I mean, it seems like transportation costs, if we take a look at the freight index, thankfully it looks like they're dropping, so it's actually cheaper to ship things across the ocean or across the major oceans and the major trade routes and trade lines and everything. That's a good thing. I think that's great. Obviously not back to the pre-2020 or just like pre-March of 2020 COVID pandemic standards, the pre-COVID pandemic standards. It's not as low as that yet, but it is down almost 70% from where it was, which is, I think, a very good thing. It's definitely looking up. A major contributor to, I think, the price of goods increasing wasn't just the fact they printed like $7 trillion in a month, but it was also the fact that there is a supply crunch going on and shit got more expensive. Like the price of a home jumped significantly. I think up like 25% from 2020 to 2021. I think that's the number that they're running with. And we're going to talk more about what's going on in the real estate market in just a little bit. But to run it back, I do think it's important that, and I think it's generally a good thing that inflation is slowing down. Obviously, we want to be sitting at around 2 to 2.5% inflation. And being at 7.7 is a lot closer to the 2% to 2.5% inflation or average inflation rate that we're wanting to get to than 7.9%. But also the consumer price index, and I've spoken ad nauseum about this, but the consumer price index is like a very skewed piece is a very skewed financial instrument, because this 7.7% that the CPI rose, they're not talking about they are talking about the price of food and the price of energy and shelter, rent specifically. They are including those things, but they're at a significantly less weighted rate than what people think they are. Give me one moment. I just want to check the audio and make sure everything's looking good. Test. Make sure everything's looking good. Okay, sweet. The last few of these recaps that I've done, I'm sure everyone has noticed. I accidentally streamed and I was muted. But no, everything's looking good. Let's take a look at the inflation breakdown. So here are some of the core categories: food at work plus school up 95%. Eggs specifically 43%. Public transportation up 28%. Butter and margarine up 33%. Utilities, aka piped gas services, 20%. Health insurance up 20%. Energy overall is up 17.6%, and food at home, so actually preparing food and stuff like that, it's up 12.4%. So the inflation at 7.7, and I guess we can take a look at I guess smartphones are down 22.9%. So at least the most important consumer staple, our smartphones, are down overall. So you know what? I can't complain about that. But the thing is with these CPI numbers, I understand it's we don't want to include or give a higher weighting to the more volatile things like food, shelter, and energy. But when you're talking about inflation and consumer staples, those are the most important things. The core CPI should literally just be food, energy, shelter, and then throw gasoline in there. And then weighted adjustingly or weighted accordingly or whatever. But yeah, the CPI numbers are skewed. Energy is still up 17.6%. Food, in terms of food that you can go out and prepare, so you get raw ground beef, shredded cheese, milk. Those things are still up 12.4% year over year. But at least it seems to be slowing down. I guess that's a good thing. Eggs, though, I don't know, man. I don't know. 43%. Those some bitches gonna be. They may be a little more expensive. Who knows? But at least from an actual CPI level, stuff seems to be slowing down. At this point, I don't. And this is something that I've made very clear to the millions. This is something I've made very clear every single time I talk about these things. I'm not someone that has a crystal ball. I can't see into the future. I don't really know what is going to happen in the future. No one does. That's kind of how the future works. I can only tell you what's going on right now, and I can give my opinion on what is going on right now. In terms of doing and having solutions and things that I wish to see implemented, I in my head think that certain things could work. That doesn't mean I know they are going to work unless, they've been attempted in the past in the exact same market conditions as right now. But that's the thing with market conditions. They're never the same. Most of the time, the market doesn't repeat itself, it rhymes. And, I think we're seeing that right now. We can take a look. So it is the annual rate, the CPI's annual rate is down from June's 9.1% pandemic era peak and September's 8.2% reading, but it's still hovering near the highest levels since the early 1980s. I will say this. I do think at some point the physics will catch up. There are specifically debt-based assets. Hold on, I just want to make sure this went out. Sweet. Yeah, I just specifically on debt-based assets, and we can take a look at Graham Stephan. Man, dude, Graham Stephan is truly putting out some of the absolute greatest content of all time. I absolutely love this man. But let's take a look here. There we go. Yeah, so there are debt-based assets, and at some point, these physics are going to catch up. So this on the y-axis, this is showing the price of real estate, and on the x-axis, this is showing the interest rate percentage point from 1988 to 2002. Now, when you have lower interest rates, typically the price of real estate jumps because it's easier to finance a home, and then you have more bidders and more liquidity and more competition to actually try to get a specific home. And as the interest rates go up, the demand goes down, and thus you have buyers and sellers trying to find a better price to actually try and offload and liquidate it. With the markets tightened up, it's more difficult to find someone that's willing to lend to you, and in turn, the price of a home goes down because homeowners are trying to sell to someone and they can only meet a certain price. Plus, if mortgages, are at like $3,000, no one wants to finance a home for $3,000. But if you take a look up here, where we are basically up about 2 weeks ago, at the end of October 2022, this is an anomaly. What's going on right now is an anomaly. So as the interest rates have increased, the price of a home has stayed, if not increased a little bit, to 2021. And at some point, the physics have to catch up on this. Just going off of overall historical data and trend lines, there will be physics that catch up and bring the price of a home down. And I think overall, it's probably going to happen to most things. I mean, most debt-based assets are 100% dropping in price as these markets have tightened up. We are steadily starting to decrease in terms of price points on like cars. But it's only down maybe 2 to 3% each year versus what everyone's kind of anticipating, especially with such a drastic rate increase. I think stuff is going to start slowing down. I definitely think that inflation, at some point, it's going to hit a critical mass where the amount of liquidity that's there, it's going to start to fall off. Plus, with how year-over-year charting works, like I said, it does look like we have started to stagnate from a CPI year-over-year perspective. And I think going into 2023 and probably 2024, I think based off of historical market data and trends in terms of when you bump interest rates, what happens, I think that stuff is going to start to slow down and we will see drops in the CPI. I think that's a good thing. And I think that we are steadily edging over to that point, but right now inflation still is at 7.7%. Now, speaking about real estate, we can take a look at home buying sentiment. Or excuse me, this is consumer sentiment. So even with inflation dropping, consumer sentiment weakened sharply in November. It is down 8.7%. The consumer sentiment is down 8.7% from the previous month's reading. And this is from the University of Michigan Survey of Consumers. So most consumers don't think this is a great time for the economy. And we are a reactionary being. We do think we tend to be a lagging indicator, Homo sapiens, that That is, when good things happen, in retrospect, we think that good things are going to happen. When bad things happen, and we look back in retrospect, even though things may be changing in the present, but we have to take a look at the past, we do believe that things are going to get worse. So maybe we have reached a critical point, at least with maybe with inflation, where it does seem to be slowing down, but consumers are still, mentally in a period of high inflation, which we technically still are in a period of high inflation. We're at near 40-year highs. Obviously, we're coming down from where we were 5 months ago, but still, we are still near 40-year highs, and definitely higher than 2.5% inflation rate, or the 2.5% CPI. So again, it is something to take into account, this consumer sentiment, but this really is not, I don't give it much weight, but it is something to take a look at. Now, here's something that may be causing this weekend consumer sentiment. Homeowners have lost $1.5 trillion of home equity since May, and the average borrower, and I don't know, I think this is taking into account anyone who has financed a home since May. I believe that's what they're doing. So anyone who's financed a home since May, but it may just be any borrower in general, has lost $30,000 in equity. Homeowner equity peaked at $17.6 trillion collectively last May after home prices jumped 45% since the start of the pandemic. At the end of September, prices were still up 41% and equity was still quite strong. Borrowers who bought their homes before the pandemic collectively have $5 trillion more than they did before the pandemic hit. That translates to a gain of $92,000 more equity per borrower than in February of 2020. So I think that average of $30,000 in equity, I think that is taking into account anyone who is financed, I think just like after the pandemic started. But yeah, so everyone, I mean, it's really not a surprise. Like consumers, they as you start to lock up credit markets, there is less demand to purchase a home, and frankly, no one's going to finance a home at $3,000 a month mortgage, 30-year fixed. That's crazy. Obviously, you can refi down the road, but that's ridiculous. You might as well just rent at that point. Unless you're purchasing like an absolute killer home, I wouldn't personally do it. I would not personally finance a home at $3,000 a month. If it's like an average American home, obviously, if you're getting a dream home or you're getting a forever home, that's one thing. And then if you do end up financing it at $3,000 a month, I would personally recommend to try to refinance it afterward once you get more equity in it. But this is not a surprising thing. I'm not surprised. If you look at Zillow or Redfin or Remax, they're laying off employees. You're seeing housing drops happen the fastest in the last few months since last decade. So this is it is pretty. I mean, it's not unprecedented. I think it was expected, but it is unprecedented in terms of what was happening to the housing market, especially within the last 2 years. But definitely over the last 10 years, it's been frankly that up-only philosophy. I mean, same thing with the market in general, but it is that up-only philosophy. To continue on with the real estate market, and it's not just equity that's being lost, but it's also consumer confidence hitting new lows. So people are losing confidence in the real estate market, according to Fannie Mae. In October, just 16% of consumers said they thought now is a good time to buy a home, according to a monthly survey by Fannie Mae. A higher share of consumers, 37%, said they expect home prices to drop in the next 12 months, according to a Fannie Mae survey. Now, again, consumers, and more specifically humans, are lagging indicators. Let's make that abundantly clear. And obviously, we are a reactionary being, but it is certainly something to take into account, like I said. Now, the share of respondents who thought now is a good time to sell a home also dropped from 59% to 51%. Fannie Mae's survey looks not just at buying and selling, but tests sentiment about home prices, mortgage rates, and the job market. It combines them all into one number, which also fell for the 8th straight month and now sits at a new low, which and this survey began in 2011. Fast rising interest rates are what turned the red-hot housing market on its heels in early summer. The average rate on the popular 30-year fixed mortgage started the new year, or the year near a record low, around 3%. By June, it crossed 6%, and it's now just over 7%, according to Mortgage News Daily. Quote, as continued affordability constraints reduce home buyer demand and homeowners become reluctant to sell at potentially reduced prices, we expect home sales to slow even further in the coming months, consistent with our forecast. Now, I do want to say this. In terms of the actual mortgage rates, we did cover them on the Dylan Hoy Experience a few weeks ago, and I do want to give an update. I do think that's an important thing to do. So let's take a look at mortgage rates. So they are coming down. They did peak in about late October into early November. I know at least in California, off of these numbers that Google gives me, the 30-year fixed peaked at 8%. It was over 8%. It was like 8.01% for 30 years. The 30-year fixed has come down to 7.315%. So we are making some headway there and bringing the interest rates and the 30-year fixed average back down to 30-year levels, 30-year highs, 30-year mortgage rate historical. And we can all, and I just like taking a look at where we were throughout history in terms of our mortgage rates and everything. Let's just take a look at the Freddie Mac number. Dude, if y'all don't put this into a chart, I'm going to cry. What? Okay, thankfully the Fred, shout out to the St. Louis Fed for the Fred data. I absolutely love this site. This is just consumer porn for me. So we are back. So it's 7.08%. We're sitting at about, the closest time recently was like 2007, but if you want to run it even further, it's probably going to be around 2000. So we are still back at 20-year highs. Maybe we do enter into that Volcker era level of the 30-year fixed, where like we go back, obviously, and we go back to like the double digit numbers. I will say the Fed has been talking about, being reactionary to CPI numbers. So if the inflation rate does start to stagnate, come down, the CPI does start to stagnate, come down, they will start dropping interest rates again. So obviously, I don't know if it's going to be doom and gloom. That being said, if they do go back to double digits, if not higher, and they can't get inflation under control, and we do end up seeing, the 30-year fixed back at, 18%. I don't know if that'll ever happen again. But if we get it back to 18%, what's the median? Let's see what the median price of a home on October 9th, 1981 was. October 9th, 1981, median home price, America, USA. Let's just take a look at 1981. 1981, the median price of a home was $68,900, and then adjusted for inflation. When was this done? 2017. You know what? Let's just throw it into our into the inflation calculator, and then that way we can just get a solid, good number for it. So let's take a little gander here. $68,900 from 1981. So it would be $225,000. So if we take a look at how much home price or median home prices, Fred. There we go. Median sales price of a home. Let's go. Okay. Yeah, I don't think this is not adjusted for inflation. So we're just going to go off of those numbers. So yeah, at these prices here, the median price of a home in Q3 was $454,900. The median price of a home, when adjusted for inflation, was $225,885. So if we take a look at what a 30-year fixed would do, if we see it back at double digits, we are basically getting 40% sliced off of equity in the real estate market. I don't know if we'll ever go to that extreme again, But we did just come out of the polar opposite extreme where interest rates were literally at 0%. And we saw 30-year fixed mortgages under 3%. So again, it's ebb and flow. It's reflexivity, where if you drop interest rates to zero, the equal and opposite reaction to that is to have interest rates go back to an extremely high position. And if so, then we will see debt-based assets, real estate specifically, just gets absolutely hammered. And the price and the fact that a median home in America in Q3 costed $454,000, almost $455,000. Physics will catch up to that because the thing with interest rates and financing is that it is the lifeblood of the real estate market. Like people don't just go out and buy houses in cash. I mean, I guess you can, but it takes a lot of time, a lot of energy, and most people are better served by just financing a home for 30 years. That's like, there's nothing wrong with getting a mortgage. You know, people say debt's bad. I also tend to agree. I think overall, if you are carrying balances in debt month over month, I generally think it's a bad thing for your finances. But a mortgage is something, at least for like personal use. I think financing it is fine. Once you get into like the business side of things and you start doing investment real estate, then it starts to get a little more nuanced. But overall, I don't think financing is bad, especially for personal homes. And if we were to see interest rates continue to go back to an extreme, I think that we are going to see the price of a home get slashed. I mean, from 2007 to 2008, we saw prices go down, or from 2007, to 2009, basically like a year and 3 months. So from 15 months during the Great Recession, we went from $257,000 for a median home down to $208,000. So that was a 20% cut right off the top. And if we took a 20% cut here, we would be back down at just over 400. If we slash, $50,000 right off the top of a house, we'd be back at $404,000, almost $405,000. And I don't think that's a bad thing. It's resetting the markets back down. Speaking of resetting the markets back down, and I don't know if it's resetting, if it's just all of the margin and leverage going away. But let's talk about what's going on with FTX. Like I said before, how we opened the Dylan Holy experience today. I said this was a watershed moment in crypto. Like probably the last 5 days, in terms of what has happened, is probably one of the landmark moments in terms of the crypto industry. And let's talk about what's going on. Well, Sam Bankman-Fried, CEO of FTX, has gotten into a bit of trouble on November 6th. So 6 days ago, Binance moves to liquidate the FTT holdings, which is FTX's exchange token, moves to liquidate FTT holdings due to, quote, recent revelations. Now, what did that do to FTX? Well, what happened, and I guess we can. There's a lot of moving parts here. So let's give some background. FTX and Binance are two crypto exchanges. It's where people can go purchase cryptocurrencies. Binance owned a bit of equity in FTX, so they owned a little bit of FTX. Then they ended up wanting to get bought out by FTX, and FTX gave them FTT, which was the FTX exchange token, as well as BUSD, which is Binance's stablecoin. So they gave them the equivalent of FTX tokens and US dollars. Binance then, I guess 6 days ago, moved to liquidate the FTT holdings. A lot of people thought it may have been a conflict of interest because it was basically the equivalent of, Bank of America owning a bit of JP Morgan, and not within like exchange funds or index funds or anything like that, but like just actively owning a bit of the exchange. So FTX, FTT token, Binance ended up selling $500 million worth on the open market, and this is what it did. So at about, November 6th, they sold at about $24.72, and now it's down at $22. Then a lot of stuff started coming out. So that $500 million that Binance took in capital, ended up causing a bank run because there was a liquidity crisis. So FTX didn't have enough money on the exchanges for people to pull their money out, which caused a bank run, basically. And this is what happens with banks too. If the banks don't have enough money, people want to go out and pull all of their money out in cash. They don't have the cash to give them because all of it was propped up by leverage and margin. And they basically had created this idea of collateral and equity and having all of this money, but it was all through assets that they created. So it's Ponzi scheme-ish. What ended up happening was this bank run begins. Sam Bankman-Fried, CEO of FTX, says that the assets are fine, says that they have more than enough money, and then he implores CZ Binance, who is the CEO of Binance, to, quote, come together. CZ then refuses to, or actually, bada boom, bada bing. There we go. Okay, so FTX faces liquidity crunch and then moves to sell the FTX exchange to Binance. So Binance is then going to basically buy out FTX to cover their capital and the bank runs and everything. Same thing that FTX did with Celsius, Voyager, and BlockFi earlier in the year. SBF has then removed the tweets saying that assets are fine, and FTX goes dark, allegedly offline. Binance then, after saying that they would purchase FTX and cover all of the customer withdrawals and everything, they back out of the deal based off of due diligence. Then the crypto markets go absolutely bonkers. So this is right when CZ Binance said he wasn't going to cover it anymore, and FTX or the FTT token goes from $17.99 down to just under $5, $4.23, and it has been steadily going down since. SBF then tells investors that he needs $8 billion in funding. The FTX website then starts telling people to not deposit and they cannot process withdrawals. Sequoia Capital, who was a major investor into FTX, marks down their entire $214 million FTX stake to zero. Sam Bankman-Fried goes on Twitter, apologizes over the FTX liquidity crisis. Quote says, I fucked up twice. Then Japan tells FTX Japan to halt operations. FTX may have resumed withdrawals after that supply crunch, but then they ended up stopping them again. CZ spoke with the president of El Salvador, who has been a very outspoken investor, and I guess how would we describe Nayib Bukele? A very outspoken pro-Bitcoin advocate. I'll say that. An outspoken Bitcoin advocate. And everyone was saying that he had all of El Salvador's entire Bitcoin stake on FTX. Apparently, that is not true. The country was not exposed to the FTX situation. Then FTX US, which is held to a higher level of regulation and everything because it is operating within the United States, has announced that it will halt trading on its platform in a few days. FTX assets are frozen by Bahamian securities regulator. The Bahama-based FTX account withdraws millions of funds for others using NFTs. So now they're starting to pull money out from other people. And apparently SBF had like a back door into FTX user funds, which are considered, like, in most cases, from most other exchanges and brokerage firms like Robinhood and TD Ameritrade, Fidelity, stuff like that, they are considered off limits. So you basically have the collateral assets for the actual institution, and then you have user funds. And FTX was able to go in and use user funds to basically cover collateral and margin and stuff like that. And that's just, dude, it's just so illegal. It's just so illegal what they did. and it's what's crazy about SBF was they considered him a white knight of crypto. Like they considered him. I mean, I guess it should have been a red flag when Jim Cramer said this, but Jim Cramer called him the JP Morgan of cryptocurrencies. Bada boom. According to internal sources, all employees of Alameda Research, which was the basically like a quantitative trading fund that SBF had, they all resigned. FTX has liabilities worth roughly $8 billion, so they are in the hole. $8.8 billion. SBF specifically, his net worth just took a nosedive. So if we take a look at this, SBF had $16 billion and it evaporated to $994 million, and that was like within 1 day. So it dropped 94% in 1 day. Now I think he's saying that his net worth is about $1. FTX, FTX US, and Alameda will file for Chapter 11 bankruptcy in the United States, and SBF resigns as CEO. In his place is John J. Ray III. And funnily enough about John J. Ray III, he was actually the chief liquidator for Enron. So when Enron was melting down, he was the guy put in charge of liquidating everything. So I think John J. Ray is a bankruptcy professional. Like this dude knows what he's doing. It's just, dude, history often rhymes, man. It's very, very interesting. So the biggest meltdown in crypto history thus far is its aftermath is being dealt with by the same guy who did the single largest accounting fraud scam in the entire world. Just crazy stuff, man. Now FTX US suspends withdrawals and FTX Ventures head resigns. Now, let's talk about this right here. Suspicious move of FTX funds flagged. And so there's a thread on Twitter I found from Satoshi Stacker, absolutely fantastic cryptocurrency influencer. And he had a pretty well-spoken and succinct thread talking about this. So yesterday, FTX and its 134 associated companies filed for bankruptcy. Last night, one or more FTX insiders took what was left of their user funds, destroyed as much evidence as they could, and are on the run. Here's what you need to know. Starting at 9:30 p.m. Bahamian time, people started noticing hundreds of millions of dollars in crypto moving out and around FTX's wallets. At first, people thought perhaps it was the court-appointed liquidator consolidating funds. Quickly, that idea seemed less likely as the funds started being swapped into DAI. And the thief took enormous slippage on trades to consolidate coins into Ethereum. They also started bridging funds from Solana to Ethereum. At this point, malicious activity was confirmed when FTX's general counsel, or FTX US's general counsel, announced they were investigating abnormalities with wallet movements. As altcoins continued to be dumped for Ethereum, some users started to notice that their FTX balances had been set to zero. And then soon after the site was taken down, shortly after, users started being prompted to update their FTX app. People assumed this was a malicious update, and this was soon confirmed when the FTX community admin posted on Telegram that all funds were gone and the FTX apps and sites were now infected with malware. A bit later, people started noticing a new wallet with a multi-sig also moving coins around, and at first thought it also belonged to the thief, but was later revealed to be a white hat from FTX trying to save some of the remaining funds. This morning, it was revealed that SBF had built a back door to give Alameda access to FTX user funds without alerting the compliance team. Perhaps this was also used to steal the funds last night, or SBF and others perhaps held the master keys the whole time. Here's something that's interesting. So the Alameda research firm, their whole point and a degree for existence was to basically trade on quantitative data and make money. And obviously FTX and Alameda Research were very tight-knit. But dude, it is truly staggering how illegal all of this went. So Alameda Research had their money and they put it down on trades and then lost all of that. Then they used the FTX collateral, and FTX basically gave them all of their money to make that money back with those trades, and then they lost FTX's money. Then Sam Bankman-Fried and the people at FTX built a back door to take user funds and not have it alert anyone, and then give it to Alameda Research to make the money back, and then they lost that money, dude. I think that if you've lost like $16 billion worth of money in terms of trading, in terms of like actually going out and like trying to like leverage trade and shit, just give up, man. Just dollar cost average at that point. It's not hard, and we're going to talk about that later, but please, just dollar cost average. Stop taking leverage to do these fucking scalp trades. It's just, oh my God. All right, let's continue on. It has also been revealed that FTX executives also knew that customer funds were being used as we all expected. So what now? This morning, Kraken stated that they have identified the thief of FTX funds. However, it is clear that they are on the run now, so we will have to wait and see how long they can evade the law before finding out if any of the funds can be recovered. Anyway, yeah, you know, the thing with the FTX situation and the Sam Bankman-Fried situation is this is what happens when you don't have regulation. And, you know, a lot of my friends have asked me, and I've had conversations with people about the regulation of the crypto industry. This is why I am for it. Because there are people trying to pull out billions of dollars from FTX, and they just can't. Like, they lost everything. It's insolvent. The second largest crypto exchange in the entire world a week ago, insolvent. This is why we need regulation. And, you know, everyone thinks this is the end for cryptocurrencies. And you know, people have their arguments for it. This is my view. This is what I'm doing. This is what I'm going to continue to do. And you know, people, they can come out, and I'm sure they'll be able to clip it. And you know, maybe Bitcoin goes down to 12,000. Maybe Bitcoin goes down below 10,000. But here's what I'm doing right now. And obviously not financial advice. This is just my experience. This is what I am doing personally. So take it that what you will. I'm a 20-year-old Zoomer on the internet who, up to this point, people could make the argument that I've had very poor risk management. But I'm dollar cost averaging. I'm going to continue to dollar cost average into Bitcoin. I'm still confident in this. What's funny is all of this meltdown stuff happened. You know, SBF goes insolvent. FTX goes insolvent. User funds suspended. Withdrawals suspended. Billions of dollars taken. Thieves on the run, on the go. I still believe Bitcoin endures. I choose to invest into Bitcoin. I still think having Ethereum exposure is a good idea. I will still be dollar cost averaging into Ethereum. Even Solana, you know, the cryptocurrency that is tied to SBF Alameda. I'm going to continue to invest into Solana. That being said, with Solana, the team is actually separate. So the Alameda research team, and just so everyone knows, I do have Solana. I'm sure everyone can assume that, but I just want to make it clear. I do own Bitcoin. I do own Ethereum. I do own Solana. And anything that I purchase, that I personally own, I will always tell you, I will always disclose holdings. Anyway, with Solana, they technically are a separate entity, and they are well funded. And the actual blockchain itself, it hasn't been paused, hasn't been halted, transactions suspended. I personally am choosing to invest into Solana still. I'm still dollar cost averaging. It's a very small part of my portfolio. It's about 3% of my allocation with both Solana and Ethereum, but I still own Solana for right now. I'm gonna continue to dollar cost average into the S&P 500. You know, even in these times of great unknowns and market volatility, and it seems like it's always unknowns and market volatility, really. But I'm going to continue to dollar cost average. I can't tell you what to do. I'm not going to tell you what to do. It's your personal decision. Obviously pro-choice, but I'm going to continue to choose to invest. I think that Bitcoin endures. I think Bitcoin goes up in price. I think Bitcoin goes back to its all-time high. I choose to believe that, and I choose to invest on that thesis. I think more people will begin to use Bitcoin. Again, not financial advice. And I believe that brings us to an end of our end of the week market recap. Dylan Holy Experience, thank you so much, members of the Millions, for tuning in. Once again, it truly is an honor and a pleasure to be able to speak to you and speak with you about things that we are all collectively interested in. It's fantastic. I absolutely love it. If you liked what you saw, be sure to subscribe on youtube.com/Dylan or /@Dylan excuse me. They have those new they have those new handles. So youtube.com/@Dylan. Then I want you to head over to Twitch. Follow me, twitch.tv/RealDMH. Then I want all of you collectively to head over to Twitter. Follow me, twitter.com/RealDylanHoley. You will stay up to date on any time I go live with the Dylan Hoy Experience, anytime I do key takeaways on Twitter. So every single day, Monday through Friday, I'm giving you financial news that's coming, that's happening in the markets. If you want to as well, go ahead and follow me on TikTok @Dylan Hoy. I sometimes post content on there, but thank you so much for tuning in. I hope you have a fantastic rest of your Sunday, a fantastic rest of your week. I will see you on Wednesday for your midweek market recap. And until next time, I'm out.